Welcome to the Passive Income Podcast. I am your host, Dividend Dave. Please be sure to join the Passive Income Posse by clicking that subscribe button below. I'm super excited for today's guest. Joining me, we have Danny. Danny, go ahead and give yourself an introduction.
Hey everyone. Hey Dave. Thanks for having me on today. So just a little bit about myself. I'm from the U.S., specifically the Northeast. I've been investing for, I would say, the last 8-9 years or so, since I was like 18, 19. My investing journey has been very non-linear, where where it's I took a lot of risky speculative type choices in the beginning that at the time when I was living at home should have been saving up a lot more money than probably what I ended up actually having after the first 2-3 years. Kind of just learned a lot of hard lessons because it was my own money. And what kind of strategies was I doing? I was doing like some options trading. I was doing outsized. I would purchase large positions in like kind of these more speculative stocks. It was never really a penny stock kind of thing. I did that maybe once or twice, but I was never really into that game. It was just more so not really knowing and thinking I was entering and timing a trade correctly, and then just never really knowing when to pull out. And so it was just consistent losses for a while. And then for the last maybe 5 years now, my investing strategy has been a lot more focused on just dividend investing, picking quality names. And it's funny because so some more background for myself. I went to Villanova University. It's a university here out in Pennsylvania in the U.S. and I studied finance. So you would think that I knew a little bit more than most, but it was more so I thought I knew better. And it's funny. There's a thing in the industry within people in finance even that though we may know how to talk finance, we're very poor at actual investment allocation,
The execution.
For our own personal portfolio and the actual execution. Correct. So where are we now? So I have a full-time job at Ernst & Young. It's one of the big four accounting firms. I'm on the consulting side, so I advise large banks on kind of like reporting strategies, regulatory reporting, wealth and asset management type clients, technology transformation, stuff like that. And then on the side, what I'm trying to do is really build a passive income portfolio that at some point in my career or at some point in my life, I can live off of those incomes. So again, it's been a very up and down journey, but at least for the last 4 or 5 years, it's been a lot more consistent. And I'm glad to get into some of the things that I've learned and some of the other strategies that I've done over the last few years to kind of get me to where I'm
Yeah,
now.
definitely. So a few things there to take right off the top is making mistakes in the beginning. We've all been there. Everybody makes mistakes in the beginning, whether it's, like you said,
Yep.
maybe not penny stocks, but so many people just dive in. They think, oh, this one is 50 cents a share and it's going to go up to $10 a share. And penny stocks rarely work out that way. And then getting into options trading
Yep.
or day trading. And sure, it can work out for a lot of people if you're willing to sit at a computer all day long and just watching
Exactly.
those candles, green candles, red candles, and trying to make and trying to time the market. And it's almost impossible to time the market. And with that said, I know there are very successful day traders and people that uh
Sure.
trade options and all of that. But and then you kind of got to that where we're at here on the Passive Income Podcast. It's like, you know what? If I just get to dividend investing and I get to the point where I'm looking at these solid companies, these solid growth companies, it's hard for me to go wrong. These companies have been around for 50, 60, 80, 100 years, and they've been
Yep.
paying dividends for, and or
Just as
right?
long.
Like they just keep growing their dividend. And so, yeah, I've heard your very similar story with so many other guests here on the Passive Income Podcast. So you're definitely not alone in that regard.
Yeah, and that's why I like so for those for all that are watching, right? I think we met through Twitter, and so I like the little community that exists within the Twitter Twitter sphere of for those of us that like to invest in dividends and just enjoy the passive investing strategy. Because at the end of the day, investing it's good when it's, because I want to be careful here, but it's good when there is a community of folks that also have the same ambition, same type of strategy. But it's you gotta walk that tightrope where it's like there are similar platforms or similar accounts that are always trying to pump a stock, and that's not really what we're, I think, trying to get out here. Within that dividend investing community, it's more so about like what you can achieve in terms of personal financial independence at some point in the future, just through consistent investing, saving the hard-earned money that you work for. And then at some point, you don't have to retire off of it completely, but like, it's there. It could be something that you pass on to your kids, something like that. So it really is a very simple formula to kind of just get started, right? And I think we overcomplicate it so much. Maybe it's because of all the different things that we see through the Reddits of the world, and just Twitters of the world, the YouTubes of the world. And again, you see people have like very good outsized returns that are meaningful for most people, and you're like, wow, how can that person have done it, and how can I not have done it? And then that's where you kind of can get into that rabbit hole. But then the inflection point for me really was like in a lot of other things in my life. I'm like, I was like, okay, well, because again, there's like that stat that everyone throws out, right, for like the day traders, right? Like 99% or something like that, are unsuccessful or, lose money. At the end of the day, that's what there is, that 1%, that cohort that you kind of alluded to, that, they are successful. And to be honest, I actually know some of those people who, for the last 10 years, they've done very well. But the thing is, they've also put like that 10,000 hour plus
learning curve,
training of themselves, learning curve, to put themselves in that situation. And every single one of them has had a lot of bad experiences to get to that point. But again, it's the trade-off of like, well, is that the investing style that you want to have? For most people, it's not a suitable investing strategy, because at the end of the day, you have a family, you have a job, you really do have to be in front of that screen for a very long time. It's a lot more active, and I think what we're trying to get at, it's like it doesn't have to be that hard. We could just really do have a passive investing strategy where you pick quality companies and you let them do the work for you. So you own shares, and then they pay you a stream of income. And it's really,
I love it when companies pay me to not work for them. That's one of the things I love saying.
Exactly. Right? Yeah. I know. That should just be a tag.
It is one of my, I have several catchphrases. You did say something there though about like putting in that 10,000 hours and learning from the mistakes and the failures. And it kind of made me think of a Michael Jordan quote. And I'm paraphrasing here, but basically he said something to the point of, the reason I've been so successful is because I've had so many failures. And so, and you look at those day traders, and man, oh man, they've had to have gone through a lot of failures to get to that success.
Yeah, I know. Some where I feel like, it truly is impressive, but I don't think like, for, I guess like folks like us, right? It doesn't really make too much sense to study them or study those trading habits if it's not something that you're going to apply to yourself. Like if you're going to maybe just read like a biography in a book, sure, maybe that's interesting, but not something to emulate.
Right. Well, before we get too much further into it, I do need to give a shout out to buyinvestingshirts.com. You can find the Passive Income Posse merch over there. Obviously, we have the t-shirts.
Nice.
We have the hoodies. We have what we call in Canada toques. I know everywhere else in the world calls them hoodies. There's coffee mugs. There's all sorts of great merch over there. The link will be in the description. Use code word Posse for 5% discount on your purchase. So definitely check that out. I am interested now, like, so you started at, again, very young. So you're setting yourself up for that fire possibility at whatever age, say 45, 50, 55, where you're going to hopefully be in that great position. And then, so in those last 5 years where you've gotten more into the dividend investing in these solid companies, let's dive into some of the different companies and sectors that like really light your fire, I guess, right?
Yeah. So, I mean, taking a step back too, one of the things that I never really used in my approach, and something that I tried to tell some of my younger family members, friends who are are also in that cohort of like, oh, I just need to invest in like in these things that are going to give me 100% return
Yeah,
within a week,
when you said that twice now, and all
or
I'm thinking
names.
is those meme stocks like AMC where they went
I know,
crazy, and you're
I
like,
know.
"Oh, so many people must have." Sure, some people did good, but so many people must have lost so much on those. But sorry to interrupt you.
Yeah, and at the end of the day, no, and at the end of the day, and this goes for anything. When you think about it, like if you're your own, if you're going to start your own business, right? You're not going to start your own business, or most people don't start a business in something that they don't understand. So if you're going to invest in something, put your own hard-earned money, invest in companies
Right,
you understand, right? It's very much as simple as that. And so that's like an approach that I never really took. And then from like the first 4 or 5 years that I was investing in crappy stocks, I looked at all the good quality stocks. Now, what are those good quality stocks? Things that I knew about. Like I'm talking about McDonald's, Starbucks, Domino's Pizza, Home Depot. Um, there's Nike. These are just like a list of some of these brands, quality companies that once I actually started doing the research, I'm like, wow, I use these on a day to day, or not day to day, but like I everyone
yeah,
knows about these products. These are products that there's really never a problem in terms of the demand for that product. So there's always going to be, they're always going to be successful businesses. They are in some respects. Oh yeah, how can we forget the tech companies, right? Your Microsoft, Apple, Google, Amazon. I think I mentioned them, but these are just like little
right.
monopolies in their own industries. And so when you kind of think about them, put them all together, if I just grab what I just mentioned into like, and put them into like a little basket, all those companies have outperformed so well over the last few years because one, they've continued to grow revenue at a very good pace. Some of them pay dividends and have paid dividends for a long time. And again, they're companies that I know, and they're companies that I know
Right.
what products they offer. I've even bought some of their products. We all
Yeah.
have at some point. And it's like when you start doing that, then you can kind of go into a little bit more about, because again, I also came from a finance background. So I have the skill set to be able to actually then go into a company and look at their balance sheet, look at their income statement, cash flows, analyze it a little bit better using the more fundamental approach rather than like a, hey, and this is more so something that I enjoy. So again, we're talking about kind of passive investing where, you just pick quality companies and just kind of
Yeah.
do it consistently. I personally enjoy doing some more research. So like that's just more something that I've learned. But yeah, so tech, technology, the consumer discretionary companies like Target, Home Depot, stuff like that. That's something that you really can't go wrong investing in quality names that you're familiar
Yeah,
with.
I would add a couple to the list, that you mentioned there: Coca-Cola, Pepsi,
Let's hear it.
Walmart, Costco,
Yep.
right? Like, and everyone's familiar with these
Oh yeah, the list
brands,
can go on and
and
on.
you go in, you shop there, you shop at Costco or Walmart, you buy Diet Coke, and you buy Frito-Lays, which is obviously the Pepsi, under the PepsiCo banner, and yeah, just buy what you know, and I think to your point, that's a great advice for someone starting out that may not have your skill set to look at the balance sheet and everything. You know, these are really solid companies that have been around for decades and decades, and you know they're going to continue to grow. You know
Yep.
that every single day people are going to go to McDonald's, right? Like,
Yeah, exactly. That's like my go-to spot when it's like 1, 2 in the morning and I know everything else is closed. I come back from like a bar with friends and I'm like, all right, the only thing that's open is McDonald's, man.
yeah, it's like I've said this one before too. If I had a McDonald's share for every Big Mac I've ever eaten in my life, right?
Yeah, right.
Nice, nice. Yeah, I think that's great. And a lot of my viewers and listeners know that I kind of lump that into my turn that cash register around strategy, where the turn that cash register around strategy is sort of more like, okay, invest in the company that you pay your phone bill to, invest in the company that you pay your, like the bank that you pay your mortgage to, invest in the power company that you pay your electric bill to, like, but still very
Yep.
much similar that, hey, you know what? I'm buying groceries or whatever, right? Buy the companies that you're buying, because if you're buying them, odds are good. If you're paying these companies, whether it's a bill or you're buying your groceries every week, odds are good if you're buying from those companies, other people are buying from them as well, right?
Yep. And especially if they have global reach too. I think that's something that, you also, as you kind of start looking into some of these companies that we're talking about, if they have a global reach,
Right.
even better, right? Because, some of these with whatever happens in the US, that might not also be the case in Europe or in Asia,
Yeah.
right? They're kind of different economies. And so you have that diversity too, to be honest.
Yeah, and I think Coca-Cola and McDonald's are prime examples of that where,
Yep.
you know, probably two of the most successful American companies of all time that are in, I think, every country in the world except maybe North Korea and Cuba. I'm not sure if they're there or not. Probably not,
Probably
just
not. Yeah.
because
Who
of
knows?
politics. But and well, and I guess McDonald's is no longer in Russia, but that's again politics. We're not going to get into politics here, but um, yeah.
Huh?
So in 194 countries around the world, that's probably, like you said, pretty good diversification. They're making sales 24/7. Like you said, even here, they're open 24/7. So they're just whatever time zone you're in, McDonald's is making sales, right?
Yeah. Yeah, exactly. And again, these are just some, right? And so like this is where, if I was going to give advice to someone who's starting out, or even someone who, is trying to change their approach to kind of be more of a, like they're looking at their portfolio and they're like, all right, well, like maybe like I need to consolidate some names, or I have too many, or I need to get better quality. It's like, all right, well, what do you define better quality? I think what we're saying here, the theme is, buy something
Yep.
that something that you're aware of the product. um, and then what I like to do personally is, as we probably all know, there's a lot of ETFs, right? So we're talking about right now
Yep.
individual stocks. If that's not your kind of game, picking individual stocks, you can always go for an ETF, right? Which is basically going to just track an industry, and it's going to be a basket of some of these companies that we're talking about, and you get less individual stock specific exposure, and you just kind of have
In a
it,
basket.
yeah, in a basket where, at the end of the day, you're not going to have to do too much homework or really look into anything too much. But what I like about that type of strategy too, um, is that, when you look at some of the examples of the ETFs that I track, the S&P 500, so SPY, you got the different Vanguard funds. All these are really great barometers that I like to use when I'm evaluating against some of these individual names that we were just listing, and how have they performed compared to the broader market index, which is the S&P 500, VOO, VTI, all these names that I'm sure our community is aware of. And if not, these are some great indexes that
Yeah.
everyone should look into, because these are all ETFs, the Vanguard ETFs, very low cost and just solid ETFs that are really just have always gone up over time. And so when you look at an individual stock, just literally just measure how it's performed over the last maybe 5-10 years against the broader market index. Has it outperformed? Has it underperformed? And then kind of like, start doing that little research, but it's like a good
Yeah.
observation to make as well. And then what's also great is that then when you kind of take the dividends that some of these companies pay, sometimes with dividends, they'll have outperformed some of these broader market indexes a lot more, if they've grown in that same time frame. So again, this is a winning strategy. Like we've talked about it, and we talk about it at length. So many people in the dividend community talk about it at length, and it's something that I think, with the exposure that a lot of us here in the community and just dividend in general that I feel are kind of getting a lot more broadcasted in like the world of like social media. I think hopefully there's going to be a lot more people like us who are becoming a little bit more aware of their finances and aware of, like,
Oh,
their
definitely.
investing
It's like,
habits. And
you're 20 some years younger than me, and we did not have this 30 years ago, right? We did not have the internet, and we
sure.
didn't have the ability to research everything and go and, you know, download an app on our phone and buy fractional shares. Like things were way, way different 30 years ago. So like yourself and your
Yep.
generation and the young adults younger than you, are in a great position to be able to find the information you need. Download that app on your phone for free. Buy a fractional shares, commission free, right? Like you
Yep.
have literally the world at your fingertips. Like literally at your fingertip, literally your fingertips, right?
Yeah, yeah, yeah. No, again, yeah, I think it's great to have, like, podcasts like these where you kind of have people who've been through similar, because again, everyone I think has to
Yeah,
stumble at some point in anything in your life to kind of, there has to be some kind of adversity. When in our realm of investing, my adversity was basically investing things I didn't know, losing my own hard-earned money, and then it's like, all right, well, I kind of have to take a step back. It's like, okay, I'm doing something wrong here. Well, how do
how do
I
I the ship, so to
enable
speak?
myself to kind of, exactly, how do I steer the ship the right way? And so I feel like I've done that. And again, all the things that I have been buying over the last few years, um, I really have held and not even sold. And I don't have any intention to. Again, it depends on whatever everyone's strategy is. But if you're a true passive income investor, that's what it is. Passive income is just it's passive. So just continue to accumulate, be consistent. Whether you do that through automating, something from your paycheck that goes into your Charles Schwab, your Robinhood, your Fidelity, your wherever you have it. As long as it's not FTX. Yeah, just any way that you can kind of just do that, and really just put your phone away for most people, right? Just put your phone away, take care of yourself, and just watch that grow. And the thing is, a lot of people, I feel like, want to see the results of these things in a very short time frame, and that's also, I guess, a direct correlation with kind of just like the attention span of a lot of people like my age or younger, who I feel like they just need, like,
The
they show me
TikTok
now, like, give
generation,
me
it's
now.
like,
I want
we
this
don't
now.
want our videos longer than 45 seconds, and I've even after 35 seconds, I've lost
Exactly.
interest, right?
Exactly, and you see that with, again, with like the Wall Street Bets or Reddit
Yeah.
folks who make it seem that it's a very easy thing to make 100% returns consistently, like every week
Yeah, good
or
luck
every
with
month,
that.
and then you look at, yeah, exactly, that's just like non-existent, and that's something that even the best traders in history have never been able to do. So um, so yeah, so I think it's been an interesting journey, at least to say the least. But again, now it's a lot more easy. I sleep a lot better at night for
Well,
sure.
and that's the other part
And
of the dividend investing, right, is, sleep well at night. You did mention, sorry, you did mention, I'll just, get this teed up for you. Uh,
sure.
all the companies that we were just previously talking about, the McDonald's, the Coca-Colas, the Home Depots, and then you went into, ETFs, and you didn't mention SCHD. Was that just a
Oh, it just happened to
okay,
not cross my mind. So I do have some SCHD. Yeah, SCHD, SPHD, and again, these are just great quality ETFs that are actually they're actively managed, meaning that there's someone else, you know, evaluating what makes up the composition of that index. And so again, I don't have to
right.
do any of that. Someone else is doing it, and they have very strict guidelines of, as far as how consistent has a dividend been for this company. Are they growing at a set rate? Are they paying a dividend that's uh, too high as a percentage of their earnings? All these kind of metrics that we don't have to, or that most people probably wouldn't know how to
Right.
do. And you're having an actual fund manager. I think it's issued through Charles Schwab, if I'm not mistaken, and basically you have a basket of goods here, of securities or stocks, companies that you can invest in, and they just pay you a very nice a nice yield. I think it's around like 3-4%, and they've actually tracked the S&P pretty well in that same time frame, that since like they've been around. And it is one of my quality dividends that I'm actually trying to build a much stronger
Right.
and larger position in, because I think I've only found out about it in like the last year and a
Yeah,
half.
so it's basically on the very, very, very top of my, US stock watch list, and I'm really just waiting for, the Canadian dollar to get stronger for a better exchange rate, before I dive into that pool.
Hmm. Nice.
And that's pretty much the number one thing holding me back from, investing in a lot of, US companies is just the exchange rate. Luckily, obviously, Canada is, has several great companies to invest in as well. Uh,
Hmm.
the most popular on here on the Passive Income Podcast and also on Dividend Twitter is discussing the Canadian banks and the banking sector.
BML.
And I did know
Yeah.
and I did
BMLs are
notice
great.
on your, Substack, which I will put the link in the description, your latest article is about the unraveling of Silicon Valley Bank. So, I guess just,
Yep.
let's dive into the banking and financial sector.
Yep. So for so I actually work in advising some of these larger banks. So it's been a very interesting time to say the least. Some of these conversations with the executives over the last few weeks. And so again, there's definitely been a lot of uncertainty. A lot of the uncertainties are more so around the deposits that folks have, and if those deposits are
Right.
safe. And again, what I think is important for most people to know, and again, this was a U.S. specific issue. So the Silicon Valley Bank is not a bank that you or me would have had funds in. One, that was a bank that the composition of the deposits that people had in there were either investors or very wealthy investors or tech entrepreneurs. And so the reason that everything escalated so quickly and that there was like this big withdrawal of deposits that kind of then had this spiderweb effect across the entire industry where everyone just kind of felt like nervous and started pulling their money out was more so the speed at which the withdrawals took place. And so because we live in a digital world now, 20, 30 years ago, the infrastructure was not in place for you to just, log onto your phone and just click withdraw money. You actually had to make a line at the
I
bank
remember, I was
and
there.
withdraw money. Yeah, and I'm sure it's a lot easier now, right? We all have back to you what you said, everything is in our fingertips. So also given the nature of where we're at now and the nature of that bank, since it was very tech heavy, all these entrepreneurs talked amongst each other. They were all worried, and so they pulled money out. And the speed at which it happened, almost any bank in that same situation, regardless of how great they were, would have probably experienced the same type of bank run. It was just obviously, it was a siloed really just to them because of the losses that became that were brought to light through a report, and then again just through the Twitter sphere maybe, or just through conversation. Now, for people who still feel like that they're not at ease, I would say that at least here in the U.S. we should be very comfortable that at least having your money in like the larger institutions, who are those, the JP Morgan, Bank of America, the Wells Fargo, Charles Schwab, Fidelity, all these institutions are very strong. And I've actually seen a lot of inflows over the last few months from maybe your smaller regional banks. And why is that? Well, think about it. Your smaller regional banks, though they are very critical for small businesses and for people like in the, the broader economy, they do have less strict guidelines in terms of when you compare them to some of the more larger institutions. So they also don't have the type of tech infrastructure in place. So when I say tech infrastructure, I just basically mean like, how we have here in the US, if you open up an app from like a Bank of America or Wells Fargo, it's a very easy, clean user interface. Everyone has learned at some point, or at least now, how to use it. Whereas some of these smaller banks, they don't have really the capital to invest in such, technologies to kind of basically bring their own firms to the 2023. And so because of that, I can say that I wouldn't say I would say with confidence, but it's definitely something that as far as the industry overall, there's definitely still an air of skepticism or uneasiness that some of these regional players will still continue to see a strong slew of withdrawals for the months to come. And that will really just make it so that some of these bigger banks that were reported recently, and for those that maybe have covered those sectors, you probably have seen that a lot of these banks, JP Morgan, Bank of America, Wells Fargo, have actually done very well over the last quarter and are probably going to do very well for the next quarter too, just because of everyone's really just kind of consolidating their money with the bigger institutions. And so I don't think that there's any issue with some of these larger banks. And so these are banks that I also own shares of. JP Morgan, Bank of America are the two that I own. I also own Truist Bank and some Charles Schwab. Recently, I liked Charles Schwab because if I think it more so had a knee-jerk reaction that was a unreasonable given their presence and how much in assets that they already manage. And so again, they're more of a kind of a growth name. I know I think they also acquired TD in their last year or two. So how that play is going to still work out, I don't know, but it is a consolidation. And at the end of the day, the banking sector is very simple and can also get very complex. But simple as in for investing, you really want to invest where the biggest player has like the most money, because at the end of the day, all the regulation is going to be always focused on those types of institutions, and banks always have to comply or else they get screwed with like fines and stuff like that. So it's not in their best interest to do things in a sketchy way.
Yeah, that's I definitely get that. Like just consumer confidence, right? Like moving money from some of these smaller regional banks where they may have lost confidence over these past few weeks into the larger players. Like you mentioned, the JP Morgans and the Bank of America, etc. Um just on a note, I don't know how much you know about the Canadian banks. You did mention TD there, which is obviously Toronto Dominion. I believe it's Bank of Montreal has been paying a dividend since 1829, so they're coming up on a 200-year anniversary
Wow.
of dividend payments.
So Bank of Montreal, yeah, I actually submitted an application to work there in their investment banking division when I was a junior in college. So actually have a few buddies that worked there. It is a good quality bank. I don't know too much about the other Canadian banks, but I do know that Bank of Montreal is a pretty high quality
Yeah.
bank in general, not just Canadian.
So basically, there's we call them the big five, and then if you add in National Bank, they're the big six. But the big five have all been paying
Okay.
dividends for over 150 years. With I'm quite sure it's Bank of Montreal is the 1829, and Bank of Nova Scotia since 1833. So these
Wow.
businesses, these banks are coming up on their 200-year anniversary of paying dividends. So I just love the consistency and the longevity. And now, obviously, they haven't raised their dividend every year for nearly 200 years, but just the fact that they've paid them for nearly 200 years, right? Like that's
Yeah, and that's things that I feel like everyone in the community who's like starting out should also try to figure out. So it's some of these things that you're talking about, right? Well, consistency in paying dividends. It's a very easy thing to just Google
yeah,
search. If you have a company in the back of your mind, just say Bank of Montreal or McDonald's, you can literally just type in McDonald's consecutive years of dividends,
yeah,
something like that, and you'll probably get a bunch of articles that really kind of tell you. And then um, if you find out that they've been paying it for longer than you've been alive, it's probably I wouldn't say it's probably a good bet, but it's probably a good probability that they will continue
right,
to consistently pay it.
right.
So
Or paying dividends for longer
it's a
than
good thing to know.
Canada has been a country.
Yeah, exactly.
Crazy. Let's jump into another sector. I don't know. Where do you want to go? REITs, telecoms, healthcare, technology.
Um, sure. Let's dive into technology. So technology is one that at least from what I own, I like Tesla. I have Amazon, Google. So some of these actually do
Right.
not pay dividends. However, they're monopolies in their own industry, if you will, right? Tesla within the EV market, and again, for me, Tesla is more than just an EV company. They're a data company and
Yeah.
AI company, and so I just have a strong conviction for them for the long term. And Amazon as well, right? In e-commerce and with their cloud business, which is Amazon Web Services, that basically underpins almost the data infrastructure of any company. That probably most of the companies that we actually talk about have their data with Amazon. And if it's not Amazon, it's Google. And if it's not Google, it's
Right.
Microsoft. So those three right there in tech, those are the bellwethers of tech that I think will continue to do very well. Obviously, some of their products are, what we call in the industry is kind of like the enterprise spend that a lot of their customers, use from them. I would say is probably going to take a hit given where rates are this year, and just kind of professional services businesses, anything that where you require a service, it might take a hit, but I think in the long term, everything's going to be fine. We've in the last few years, doesn't matter I don't know the time frame we want to look at, but let's just say in the last 10 years, right? I think we've been through multiple spats with China. We've had war this, war that, which is unfortunate, but it's like it's always, there's always something going on, and there's always in some kind of energy crisis. And at the end of the day, some of these great tech stocks that we're talking about, to be honest, like, because of the fact that we use technology every day, they're not really going to be unaffected by a lot of this kind of global socioeconomic issues that sometimes may seem to take more precedent in terms of a good investing approach. So I think for me, I like to stick with some of those big guys. I don't personally spend too much time looking into some of the smaller players or trying to find a player that, because at the end of the day, these companies are a lot more mature. So when you think about growth, if that's something that you're interested in, right? I know that I'm not going to make maybe a 5x return on Apple or Microsoft, because if that were the case, they would be, multi-trillion-dollar companies. I think they can get there in the next 10, 20 years. Sure, why not, right? If anything, they are the companies that have the capacity to consolidate the industry whenever there's a good player. And they've already done it. Remember, Microsoft bought LinkedIn. And so they will probably continue to do that because they have the cash to do so. And so I just rather invest in them, just because, why not invest in the number one or number two or number three?
Great point. I did just want to mention though, Canada managed, we didn't even need the US's help. Even Canada had a few disagreements with China over the last several years. So
yeah. No, exactly.
Okay, so great thoughts and perspectives on the tech sector and those big companies kind of being, the major players, and maybe who knows, maybe someday down the road they will start paying dividends, or just work on that, or hope for that, capital appreciation. And I don't think it's just hope
Yeah.
for. That capital appreciation is probably going to be there if you've bought in this last window, like you said, of this last year or so, when all of those tech uh, prices have been just depressed, basically, right? And you see sort of where their all-time highs were and where they've been trading at in the last 12 to 18 months, and you're like, well, I can only see them going back to and above their all-time highs for the majority of the companies you mentioned, especially when, like, Amazon and Google.
Yeah.
Honestly, personally, I'm not as sold on Tesla as you are. I see more competition coming
Mm-hmm.
from everyone else: Ford, General Motors, Honda, Toyota, right? Like, at some point, I don't know where the breaking
Mm-hmm.
point is, and obviously I don't know where the EV market is going. Um, and that's just, again, personal opinion. You could be right. I
Sure.
could be wrong. I could be right. You could be wrong. Who knows?
No, but I think overall, I think a competitive industry
Yeah,
is a
for
good
sure.
industry. And so like you want to have competition, because like, at the end of the day, that makes you and your business have to focus on how to become better and how to, be better than your competition. And I think that's just good in general for the economy, I think. So, exactly, like the three companies that we listed, right? Microsoft, Apple, Amazon, they all are eating the share of the same
Yeah.
pie, in terms of like wanting to own customer data. And again, we all know that we don't have to go into like a customer data kind of like debate, but the thing is, at the end of the day, we all know that all these companies own our data to some way and use it, and in ways that, to be honest, benefit our habits, make our lives a little easier. And they've been doing it for a long time, and it's not just them, right? Like Target was actually one of the first consumer retail companies to actually use data to find out how consumers are spending. And this is something I learned in college in like 2013, 2014. So it's going to continue to be an industry that I rather invest in things with technology where data is very prevalent, because as you can see, data is
Right.
power. And so the companies that really are able to take customer data, make something with it, and then help make our lives easier, then that's as an investment, right? We're talking about investments here, right? So not anything else. So as an investment, I think that's something where I would probably want to put my money on. And I think now over the last few weeks, where we've been learning about kind of these the artificial intelligence wave, which I think is very meaningful. And again, I think we're still at a very
Early stage.
an early stage. Yeah, I think it's still a very nascent type of technology. It's definitely here to stay. Don't get me wrong, especially in terms of how it can make kind of some administrative tasks a lot easier, or really just make our lives a lot easier. Some of the more manual things that we do can be just done with the help of virtual assistant, or with the machine learning that sits behind AI that allows it to learn and kind of recognize patterns to then perform like someone can, right? But I think that wave, without getting too much into this, that because of you want to always be future thinking, right? The industry is always changing. Tech industry is always changing very rapidly, and so whoever is going to be, the biggest proponent of leveraging that type of technology in their day-to-day, in their business, is going to do well. And so again, as an investment, I would rather invest in those companies that are going to be the top performers, maybe in that space.
Cool. I am curious. So we've talked a lot about the financial sector, because obviously that's your background.
Yeah.
We've talked quite a bit off the top about sort of the consumer staples and consumer discretionary, because I agree with you. We eat every day, whether the market it's a bull market, bear market. Your stomach doesn't care. Your stomach just says feed me, right?
Yep.
So and then
Yeah.
obviously we just talked a fair bit about technology. Great thoughts on sort of all of these sectors. Is there any other sector that you have in your portfolio, that like something like energy, oil and gas, transportation, heavy industrials,
No,
anything?
so
What do
I
you got?
no, yeah. So I think as far as back to what we were talking about, the consumer things that we as people need. I actually own some industrial, so or utility companies rather, Nextera Energy, American Water Tower, Duke Energy. These are just kind of your old boring companies that, to be honest, are just that. They're boring. Those are companies that I don't care about looking at their financial statements. I don't care about looking at, because I just know that every single person in every facet of life in every country needs water. They need electricity, and these companies are the ones doing it. So, and they've been paying dividends for a long time, and they're not going to be your top performers like technology, but they are a
Good,
good
solid, boring. Show me that dividend. Just throw that dividend into my account every
yeah,
quarter, and
exactly,
I'm
just a
not going to
good way to
complain about it.
diversify your portfolio. Yeah, and what's good is that in times where, because of the fact that they are a much needed service that we need, regardless of how
Right.
the economy is doing, they are less prone to risk, or less prone to the market headline risk that you usually see. So when you kind of analyze some of these companies, you will never see a Duke Energy fall 10-15% if like an Apple or a Google does, right? It's more so because, again, it's a stable kind of boring business. You look at their charts, it's pretty much like this, you'll in a very slow and steady. That's really all it is. And that's more than fine for me.
I would definitely agree with your thoughts on energy, and you and I have very similar thoughts here of just investing what you know, investing what you need, investing with what you're familiar with, right? Where you pay your bills to, whatever, whether it's an electric company. Or I'm lucky. I live in a rural area, so my water is just from a well, so it's free basically. But
Oh, that's awesome. My father's from Portugal, and he's like a farm. He used to be a farmer there, or at least my
right,
grandparents were in a very rural area as well. And they also have a few natural springs that feed to the home. So it's
yeah.
it's, it's beautiful.
But yeah, no, but I get it. Where if you're living in a more urban setting, yeah, you're paying a water bill, you're paying an electric bill, you're
Yeah.
paying a phone bill, you're paying groceries, you're paying now these days obviously for an internet connection, and yeah, it's just invest in the companies that invest in the companies that you're familiar with, invest in the companies that you pay your bills to, because other people are also paying their bills to those same companies, right? So, and turn that cash
Yeah.
register around.
Exactly. And the great thing is that over time, as you do these things consistently and start investing in some of these quality companies, you can use the dividends to
Yeah,
pay your own bills.
exactly.
right. So that's a great aspect
Yeah,
of
that's the whole
dividends.
concept of turn that cash register around is like buy enough shares
Yep.
of a company that they pay you to pay them.
Yeah, exactly. Simple math.
Nice. Let's any other sectors?
Sectors, I'm trying to think. So we covered financials, we covered energy, utilities, we covered technology, healthcare. The only one that I have is Johnson and Johnson. They're probably my third or fourth largest position in my dividend portfolio. Again, they are a conglomerate. I know they also are spinning off their consumer healthcare business. I think at some point this year
Right.
or next year, but they are a conglomerate of pharmaceuticals, medical devices, and consumer. So that's why I I love Johnson and
Yeah,
Johnson,
yeah.
right? We probably all buy products that we don't even know are
Yeah.
Johnson and Johnson.
Same with Unilever and Procter and Gamble. You can just go through your house,
Yeah,
go into your
I actually have
bathroom, look at the
Unilever as
back
well.
of the tube of toothpaste or the shampoo bottle, and it's going to probably be one of those three companies, right?
Mhm. Exactly. And again, it's just like energy, utilities are a necessity for kind of day to day. So is healthcare, and so same theme as to why it's a solid investment and it will always be a
Yeah,
solid investment.
agreed, agreed. Let's just quickly go to telecoms. I don't know if you what are your thoughts on that sector? Obviously, in the US, you have your AT&Ts, your Verizons, T-Mobile, and obviously, I'm sure you have just some
Yeah.
smaller players as
So
well.
I have T-Mobile. Now I personally think that they're not my most favorite favored industry to invest in. Again, I think these are good quality companies, but as investments, I used to own shares of Verizon, but and to be honest, Verizon is one when you kind of just look at it as a business or as an investment over the last 10, 15 years, they really
Right,
haven't done much. Obviously, they've probably grown. But they do play a nice dividend, so they have that going for them. So if you kind of really just want consistency and you really don't care about appreciation, and maybe you're kind of near retirement or you want something that's going to not be very risky, for me, Verizon probably of those three that you mentioned, it has probably been the most consistent and stable um, company of them all. But again, I think for me, telecom is not an industry that I pay too much
right.
attention to. It's not one that's very interesting to me. It's kind of boring, and it can get a little complex too, especially with some of the um, well, because it's not just telecom. It's streaming, and now it's broadcasting, and now it's digital media, all that stuff that can kind of it's not something I'm familiar with or I really want to spend my time
Right.
analyzing. So I used to own Verizon, but I always used to think about Verizon actually as a it's like putting money in a savings account at the time. Um, so I think they have taken like a little bit of a hit over the last maybe year or two, but at the current price point right now, I think they're in that kind of consolidation range where I think they're kind of finding like a new bottom. But again, they're still paying that dividend. It's around like 7%. That 7% is meaningful for
Yeah,
somebody, for sure. I just I'm just I just rather kind of I guess maybe more so because I'm a little younger. I rather invest in something that's more a little bit
right.
more high growth and has a better quality
Yeah,
for my appetite.
and maybe that's why I love the telecom. So very similar here in Canada, we sort of have a big three, about to be a fourth one, and I invest in Bell Canada. They're probably the biggest of all of them, and um, a- and very similar to what you said. It's no longer just telecoms; they're now a media and entertainment companies as well. So they have had
Yep.
some growth through that over the last decade, 2 decades, or what have you. Um, but yeah, for the most part, they're just another one of those solid, boring, dividend paying companies that you don't really have to worry too much about.
Yeah, exactly.
Nice, nice. I do want to bring up REITs. REITs are definitely one of my favorites. I have several REITs in my portfolio. The nice thing in Canada, every REIT that I have is a monthly payer. And again, I get it. I say this almost on every single episode of the Passive Income Podcast. I get it. 5% is 5%, whether that 5% is paid quarterly or monthly. But obviously, there's just
Sure.
something psychologically nice to see that deposit go into your account every 30 days or so, right?
Yeah, I wouldn't disagree. I in my retirement account, I own realty income, so I definitely own realty income, the triple net lease REIT. Probably, in my opinion, again, not an industry where I've done too much research in, but I do know that of the types of REITs that are out there, and there are many, um, many with very high dividends. But I think that high dividend appeal, sometimes there's a little bit more risk in the consistency of being able to maintain that high dividend. That's why I like realty income more so, because of that monthly income payment, and because of the quality of the real estate that they invest in. I think they invest in some pretty big names like Dollar General, your Walgreens, uh, Dollar Tree, all those types of companies that are companies that pay
Right.
them rent. So um, that's definitely one that I like to own. But I actually, for kind of real estate exposure, I have I actually invest in through Fundrise. I don't know, it's an alternative asset, kind of a crowdfunding real estate platform. I'm
Yeah,
not
I've
sure
had
if
other
you've heard
guests
of it.
mention it actually.
Yeah, so I've been invested since 2018, and again, for I as a user for the last 5 years, I definitely recommend the platform in the sense that you have to understand that it's you're investing in real estate, and it's crowdfunded, basically meaning that you, me, and then all the other users, we kind of pool our money, and then they actively take that money and then invest it into actual hard assets like real estate, whether it's a commercial development, single family home, multifamily, um, strip mall,
Right.
et cetera, et cetera. What's cool about it, and then you own a small piece of that property. What's cool about it is that obviously over the last 5 years, real estate has done very well. And what I, the reason I always, excuse me, the reason I invested in it rather than a REIT is because with a REIT, it's a publicly traded company at the end of the day. And so even though the assets of that REIT might really, the assets of the REIT, right? A property is not changing in value like the stock market is every day. So um, rather, when the price of a REIT is exposed to just the kind of the public headline risk that's always
Yep.
out there, um, you're not going to really get that type of volatility through investing in Fundrise, because you're actually investing in the actual asset. And again, it's not something where you're going to be very liquid in, because you're investing in a platform that invests in real estate. So you have to understand that this is something where you're expected to have like at least a 3, 4, 5 year minimum investment horizon. So like, because again, it's real estate, right? Real estate is not like a liquid marketplace. Like no one's like exchanging houses, like, left and right, like you do like
Right.
in the
Right.
stock
You're
market.
not day
So
trading your house.
different investment
Right.
books. Yeah, I know, but that's a good idea. No,
No, nobody wants to move every single day.
imagine. Yeah, exactly. But again, that's more so my approach for investing in real estate. I like that platform a lot.
Yeah, interesting. Like I mentioned, I have had some other guests mention that. Realty income, obviously, with it's about 98% of all of the American guests I've had here on the Passive Income podcast. I'm sure at least 98% of everyone owns realty income. And it's right
Yep.
number 2 on my watch list behind, SCHD. And again, when that Canadian dollar gets strong enough, to the US dollar that I can afford to invest in some US
Yeah,
companies.
yeah. No, it's a great company, and I think the qual again, it's more so the quality of the real estate assets that they own, and the consistency
Right,
of that dividend. I think that's the most important part. In the past, I've analyzed a lot of real REITs. One of them actually being NLY, I think stands for Annaly Capital. They're like a mortgage REIT, um, but their stock has just kind of been all over the place sometimes, and they've cut their dividend a couple times, and or they reinstated it back, and so I'm
right.
not interested in that. Like I want someone who's been consistent, someone who has quality real estate, and their stock really hasn't kind of just crashed from time to time.
Before we wrap it up here, do you have any thoughts on one final, I believe it's a REIT, is Vici the one that owns all the properties or so many properties along the Las Vegas Strip?
I've heard of it, but to be honest, I've never actually
Okay,
done any
fair enough,
research on it.
fair enough, yeah. I find it interesting because, like, who wouldn't wanna own a little piece of, like, MGM Grand or Bellagio or Caesar's Palace, right? I just think that would be cool to be able to say
Yeah,
that,
yeah,
right?
that's true. No, I didn't even know that they owned properties on the Las Vegas Strip. That's like how much I
Yeah,
haven't even looked
well, and
into it.
again, the only reason I know is because 'cause I've had other guests mention it to me, and we just happen to be talking about REITs there,
Okay.
so I thought I'd throw it out there, but
Very
I
cool.
see we've already been talking for nearly an hour, and I really appreciate your time. And thank you so much for coming on. Is there anything you'd like to say before we sign off?
Um, Yeah, so I have my own personal newsletter, the Investing Informant, and I kind of go by the same hashtag
Yeah.
on Twitter, Invest Informant. And so definitely check both Dave and myself as we kind of talk about our investing journey, and would love to hear about others. So join that community. I think for anyone starting out, if you have a Twitter, you know. And you're really serious about kind of like your own personal finances, starting to invest the right way, I think there are many avenues to do so. And I think following some of these kind of like accounts that talk about their own investing journey, the things that they've learned, things that they've
Yeah.
learned not to do, is a good way to kind of start out and kind of absorb all that information if you're someone that's
Yeah,
starting out.
great advice to, learn from others basically. And of course, I will put that link in the description below for the investment informant. The Substack link
Yep.
will be in the description below. Again, thank you so much for your time, Danny. I've really appreciated talking
Thanks,
to
Dave.
you and just listening to your wealth of knowledge. And again, you're quite young compared to me, and so you're definitely setting yourself up for that fire, financial independence, retire early, whenever it happens, whether it's 10, 15, 25, 20, 25, whatever, you're going to get there and
Yep.
just keep stacking those dividends, right?
Yeah, I think for me, exactly, and for me, thank you, I appreciate that, and I've kind of come to let myself kind of feel that it doesn't matter how long it takes to get there, as long as it's achieved through the consistent kind of way
Yeah.
that I've been doing it now. Hopefully, my let's say find some way to kind of make my income grow in other ways that can then allow my passive income to also grow. So if it's 10, 20 years, I don't think that matters. It's a good way to kind of just think about, but I don't think it needs to be
No,
a hard
exactly.
set
No,
date.
enjoy the journey more
Make
than
sure
anything,
that you're
right?
doing something. Oh, I love that. Yeah.
Awesome. With that said, if you're still watching or listening nearly an hour later, you do know the rules. You have to subscribe. Those are the rules. I don't make the rules. Just hit subscribe.